customers, more transactions, that we lose the focus on the bottom of the funnel. And no matter how good you are, so both of these companies on the left and the right here are adding the same number of customers per month. But you see that eventually, if you have bad retention, you reach a point where you can't add customers faster than you're losing customers. And this is where we end up in that really frustrating growth plateau. Most of us in e-commerce, in fact, most of us in SaaS or almost any business, have had to deal with breaking through these sorts of plateaus. And it's rarely because we have 100% market share. It's usually because we're losing customers who aren't sticking around. So if you really want to see that continuous healthy growth, you have to focus on retaining those customers like you see on the right. Because retention from each cohort is asymptotic to the x-axis, you can have this long sustainable growth curve. Now, the really interesting thing about this is in the world of SaaS, this actually guides what products and features we're going to offer the customers. The quote in the bottom is actually a quote from our CEO at HubSpot. So back in 2011, we had really good top of the funnel tools, traffic tools, like blogging, SEO, social media, etc. But we had pretty mediocre middle of the funnel tools, things like email automation, drip marketing, all that stuff, that would be in the middle of the funnel. And what we found was that customers who used the middle of the funnel tools, even though they were pretty bad, customers who used that were way more likely to stick around. And so we said, okay, even though more people want top of the funnel tools, like driving more traffic is the really popular topic, instead of focusing on those top of the funnel tools just because lots of people say they want them, we're actually going to focus on those middle of the funnel tools because that's what keeps customers around. That's what helps us build that long-term retention curve. And so now obviously we have world-class middle of the funnel tools. And so this is what I encourage, especially if you're an entrepreneur or even if you have a small team. Most of us think of marketing as driving awareness and acquisition. We've got to get more people to the website, lower cost per click, more SEO, rank higher on Google, etc. But if you really want to think in terms of growth, like world-class growth teams at SaaS companies, you have to combine that whole funnel, right? It's not just getting traffic. You have to convert it. That's fine. E-commerce focuses on that. But then it's that activation, that retention loop, and that referral loop to keep people coming back, keep them around. So when we talk about SaaS economics, software as a service economics, we talk about it a little differently than transactional economics. In transactional economics, like traditional e-commerce, we usually talk about like gross margin per transaction and things like that, cost per click. In SaaS economics, they use a customer-centric framework. So you're not putting $1 into selling a $2 item. You're putting $1 into acquiring a $2 customer, right? So COCA here is the cost of customer acquisition. CLTV is the customer lifetime value. Because they're really good at keeping customers, they get to think in terms of lifetime value. And we look at these as a ratio, right? So $1 in and $2 out, that's a 1-to-2 ratio, not bad. $2 into $4 out, that's actually the same ratio, it's 1-to-2, but it means that you can grow faster, right? You can spend more money on the really interesting marketing like the world-class SaaS companies. Or you could be more profitable, $2 in and $12 out. That may actually mean that you're not investing enough in growth, right? You may be able to grow faster and have more innovative marketing, have better content, have a better experience for your customers if instead of a 2-to-12 ratio, maybe we spent $4, right? That's a 1-to-3 ratio, $4 to 12. So looking at it from, I'm not spending money to sell an item, I'm spending money to acquire and monetize a customer. Now, this creates competitive leverage. Most of us, especially in the e-commerce world, look at our businesses like the yellow line, right? We have to make a little bit of profit on every single customer. And because of that, we don't spend a lot of money to acquire those customers. SaaS economics, on the other hand, are people who are really, anybody who's really confident their customer is going to come back can actually lose money to acquire a customer. So for example, if you have a $100 a month subscription, you might spend $1,000 to acquire that customer. That's not at all unreasonable. That would be the green line, right? Because you know that they're going to stick around and eventually you're going to have superior sort of long-term monetization. Now, the worst thing you can do is be that little red line there where you lose money to acquire a customer, but then you're not good at keeping those customers around. This is actually sort of where HubSpot was when I joined in 2010, 2011. We were really good at getting customers, but we hadn't super focused on keeping the customers, or we hadn't focused enough on keeping those customers around. And we were losing them because we weren't focusing enough on customer success. And as I showed in that sort of plateau graph, that means that there's going to be a ceiling on how fast and how far you can grow. So thinking of it this way is not just a semantic distinction. It creates actual growth leverage. I can spend more money to get customers. So I have one quote that I want you to remember. If you haven't listened to anything I've said so far, you don't listen to anything else later, just remember this one quote. If you're good at keeping customers, you can spend more money to get customers. That is the core bit of leverage in SaaS economics. So we look at this as a similar funnel, but we start with what our customer lifetime value is and work our way back, right? So if your customer lifetime value is $1,200, maybe you have a $12 monthly subscription with 1% churn, and you want a ratio of 1 to 3, you want to grow relatively aggressively, you can then break it down into your funnel and know how much you can spend in each stage, right? So that means if your customer lifetime value is $1,200, your target ratio is 1 to 3, that means you can spend $400 to acquire a customer, $40 to acquire a lead, $2 to acquire a visit, if your funnel looks exactly like that. By modeling this, now we can find these points of leverage, and at $2 per visit, there's some pretty interesting stuff that you can do if you can afford to spend $2 to drive a visit to your website. Don't worry about the specific numbers here. It's the way of looking at it as a funnel, but not a funnel to sell a transaction. It's a funnel to acquire and monetize a customer. So Starbucks is one of my favorite examples of this. Starbucks, obviously a famous global brand in coffee and breakfast sandwiches, etc. Starbucks has an average transaction value of about $6. They have an average customer lifetime value of about $14,000. So if you've ever been to a Starbucks and wondered why they have great Wi-Fi and they've got big, comfortable leather couches, and they don't care if you hang out there all day, it's because the Starbucks marketers know that they're not trying to spend $2 to sell a $6 cup of coffee. They're trying to spend $2,000, maybe $3,000, maybe $5,000 to acquire and retain a $14,000 customer. That opens up all kinds of opportunities, whether chairs, Wi-Fi, big, fun things that you can do for your customers, big fun marketing. This is the power. Traditionally, we think of this as SaaS. Starbucks obviously has moved it over there. Now, there is an important danger that comes up when you start looking your business this way. I delivered this line in Turkey, by the way, and it didn't translate culturally, so forgive me if it doesn't translate culturally here. But if you study finance in the US, eventually you'll come across this phrase, which is that cash flow is more important than your mother. What that means is that if you're losing money to acquire a customer, even if you're really, really good at keeping them around, you're really, really sticky, you can grow yourself out of business. I've seen it happen with lots and lots of startups. You acquire so much revenue, but because you're spending more money to acquire those customers faster than they're reaching their payback period, you actually run out of cash and go out of business. So this is a common complaint with e-commerce companies, is that, well, we could never afford to lose money on acquiring customers. It's either because you're not getting them to pay you back fast enough, or because you don't have enough cash on hand. You look at a lot of the SaaS startups and you wonder why they raise so much money, right, when they have a very healthy model. The reason they raise so much money in investment capital or whatever is so that they have enough cash on hand to acquire the customers so that they can have that long-term monetization. Amazon is a great example of this, right? Amazon makes $300,000 a minute, every minute of every day, but very little profit because they continually invest in new innovative things like their web services, but also in customer retention and acquiring and growing new customers. They're investing that product back in that. So Amazon has a little bit easier than most e-commerce companies because Amazon has everything to sell. So you can, it's easy for them to know that people are going to come back and buy from Amazon. It's easy for them to have lots of things. I used to work at a company called buylighters.com. We just sold little lighters. The problem with highly verticalized e-commerce sales like that is that it's very hard to create a model where the customers keep coming back and keep buying more and more and more. So, we tend to, in the e-commerce space, have this inclination to go deep and have every possible thing that somebody could buy. If you feel like you can adopt the SaaS economics, odds are, unless you're selling almonds by the monthly supply or something, some monthly subscription, odds are the better way to design it is going to be to go wide. Find a buyer persona and own everything that that buyer persona wants to have in their life. So you can keep upsell, resell, cross-sell, and that's that element of customer retention that drives e-commerce. So a favorite quote on this, and the reason that companies like Amazon or SaaS companies can do such good marketing, Jeff Bezos, when he originally decided to add negative reviews to the Amazon website, he got a nasty letter from his investors. His investors, they said, listen, Jeff, we know you think this e-commerce thing is going to be big and all, but you obviously don't know how to run a business. You make money when you sell things. Why would you do anything to discourage people from buying from you? This is a common thought, right? Any money is good money is a common thought that we have, especially in the e-commerce business. When you start looking at your model from a customer-centric perspective, though, you really start to see the lie in that. Because you can acquire customers, and if they're not sticking around, you're actually going to lose money. You're going to have bad retention. So Bezos replied with, we don't make money when we sell things. We make money when we help customers make purchase decisions. And that's what the Amazon experience is oriented around for customers. Not just selling you things, but helping you make a decision. Now, they have a harder job. This is their disadvantage. Because they're the everything store, they can't have the deep content, deep nurturing experience that you might have if you own a single buyer persona. Then you can make much, much better decisions and help people make those decisions. But the way you want to look at it is, instead of that funnel, which I showed you earlier, I call it the e-commerce marketing sousaphone, because the bottom of the funnel there forms an infinite loop with the middle of the funnel. As you get customers in through the top, your goal is to keep them buying, keep them upsell, cross-sell, and resell. So the inbound commerce framework has what you might call a hodgepodge or an amalgamation of these various frameworks. So you've got this attract, convert, close, delight. That's the standard inbound marketing framework. But then you take these people who are in the relevance phase, people who may not buy from you, who may never buy from you, but you need to build an audience of those people. We wonder a lot of times with blogging, we're getting traffic and maybe not all of them convert immediately into sales. And e-commerce really likes PPC and they really like SEO. The thing is, SEO and PPC are a freaking bloodbath, right? You're just trying to destroy your margins with PPC as much as you can. And with SEO, everybody's going after those, where do I buy cheap butane lighters sorts of keywords. If you can go beyond that and focus on building an audience of people to whom your product is relevant, then you can be competitive earlier in the stages of the buying cycle and really own that decision-making process. This is one of the reasons why being able to spend more to get customers is valuable, because content is expensive, right? That sort of marketing is very, very expensive. But if you're good at keeping customers, you can spend more money to get customers. Then obviously people go through that decision-making process. The reason I like this graphic is because the arrows go both ways. It's not a funnel where we just beat them in the face until they move towards the next piece, towards purchase. E-commerce companies are as guilty of this as anybody. What do we call email marketing, right? We spam our entire list 3 times a week with a coupon. We call that email marketing. Has no respect for where somebody is on this phase. Our job is to help find out where someone is, balance the content that we're sending them. So if somebody's bouncing back and forth between a bunch of different product detail pages in the same category, they're in the comparison phase. You should send them content or deliver an experience that's designed to help them make that decision. And then once they purchase, it doesn't end there. That's where the upsell, cross-sell, resell, the repurchase phase, that customer success phase, comes into play. And then, of course, using them to acquire new customers, getting those reviews. So Gemvara, that same company in Boston, actually doesn't consider it a cost center if people call into their customer support team. because they know that if they can get people on the phone with their customer support reps, they're way more likely to stick around long term. So they actually actively solve for getting companies to call into their support team, their tech support, their customer support team, because they know that people are going to stick around. So that first half, all of this is the cost of customer acquisition, all the way through to purchase, and then this bottom half is the customer lifetime value. Now, I want to touch on just really briefly one weird quirk of this. So Amazon, these different marketplaces, what they're doing is they're leveraging something called platform strategy, which is very popular with SaaS companies. So Facebook, Google, Salesforce, HubSpot, all of these are platform companies where you've got this app marketplace and people build features on that app marketplace. And that helps the company know, without having to build a power dialer, it helps them know that, okay, not that many people are interested in power dialers, but there's somebody out there that can build that feature and have that. When you're selling on Amazon, when you're selling on eBay or any one of these marketplaces, what you're doing is helping them test which of these use cases, which of these product lines are the most profitable. Because then they know which ones are most likely to keep people sticking around for a long time. Then they know that they can start doing some of that themselves. They can start selling their own branded products. So this is sort of the evil genius of platform strategy, right? If you're really good at selling on Amazon and those customers stick around for a really long time, you're going to find yourself competing with the Amazon marketplace. So that is the end of my abbreviated short crash course on SaaS economics. The fundamental precept, again, that I want you to take away is that if you're good at keeping customers, you can spend more money to acquire customers. And that lets you do the really interesting marketing that creates long-term growth.
Thanks a lot, Sam. I mean, I've just made some screenshots to remind something to my team. In the morning, we were going back and forth with the product canvas, and we were focusing on churn itself. And I think you've nailed actually the main growth engine of any e-commerce and SaaS company, which is the retention. So what is important here is that it is not the same for every business, because we at Omniconvert, we have like 20,000 websites, and most of them are e-commerce, and we also have luxury brands, and we have companies which are selling wedding rings, right? So if you don't get married like 5 times in your lifetime, then chances that you come back are lower. So what I wanted to ask you and shift your attention and our audience's attention to is how you actually acquire retention. So what types of strategies and tactics have you seen, and if you can disclose something, because I also have some interesting findings based on our research, but I'll be happy to have you sharing some tips and tricks regarding retention.
Yeah, so I'll talk about it from a SaaS perspective. One of the core things that people don't think about in most industries is whether or not the customer is successful with the product, right? So if you're selling construction supplies or something like that, you should actually care whether or not they successfully complete their construction product. With HubSpot, with marketing software, with you guys, what matters is, are they successful long-term with their marketing or whatever? Because if they're not successful, they're not going to stick around, they're not going to keep paying us. So when you think of the companies you're loyal to, it's those companies who go one step beyond whether or not you actually buy and focus on product adoption. So if you look at Facebook, go sign up for a new Facebook account, you'll get a bunch of these nurturing emails. So even though they've acquired you, they want to make sure that you're using the software and you're being successful with their software, because otherwise you're not going to stick around. So e-commerce needs that sort of after the sale insight. Not if you're selling wedding rings. I don't know. Maybe you send content about how to survive your first year of marriage, because for married guys, that's easy. And then you can sell all those other sorts of related products.
I've just unplugged my microphone because we have some issues with the echo. I don't know if now it's okay. Please type in your chat box whoever can do that. So I think that's a very important thing to see if the customers are successful with your products. Through my experience, I've been doing a lot of consulting, and I've been building my own business, which was retention based. We are my other company is the largest online car insurance player in Romania, and we've been focusing a lot on retention. At some point, we had something like 85% retention rate, so people were actually repeated buyers. But there are other verticals like fashion or electronics, and the smaller player you are, the harder it is to install the habit for your customers to keep coming back. So one important thing is the RFM segmentation. So we've been analyzing companies that had 10,000 to 500,000 customers, and I think the metrics are pretty much the same. So mainly there is a bullseye in your audience, which are the most important customers. So analyzing your existing customers and seeing who actually buys from you, and who's valuing your brand, your support, your anything, any emotional affinity that they have with your company. This is very important, and the RFM scoring actually allows you to see, I don't know, VIP customers, like people that are having a high retention score, a high frequency in buying, and a big monetary value. So these are your most important customers. But the problem is that e-commerce, as you've stated, it's incredible. That email marketing, you throw coupons on your audience and you call that email marketing. But too few e-commerce marketers and owners are actually aware of the power of personalization on email, on whatever, and they throw money to everyone, like 5% discount to everyone is far less than I don't know, 10% discount to the most important part of your audience, and loyalty programs and stuff like that are something that it's so far from us, because they don't have like a retention strategy. They have this email marketing strategy, but email is just a channel, and the customer is the most important piece in your puzzle. And if you satisfy the customer, if you allow him to get the value from you, then he's gonna come back, because nobody wants to have like 20 vendors and 20 websites to buy stuff from. But the hard reality is that this type of segmentation is not that used, and people which are doing testing to take you into my world, because we are doing A/B testing and web personalization, and we've seen that people are doing A/B testing, like, okay, let's change the website, let's do version A and version B. But that's not the key. The key is to do personalization, like doing a version which is better than the previous one, but for the whole audience, is not the key here. But if you are relevant, and if you allow I don't know, returning visitors to have a special treatment, or mobile visitors to see products which might be bought from the mobile device. And I mean, that's the key here, then, to use that RFM scoring and to punch the visitor with a product and with a treatment which is outstanding, which allows him to satisfy his needs. I mean, that's the real problem in the testing and personalization and conversion rate optimization world, is that we keep on tweaking the UX and we forget the customer's need and what the value that he's getting from us. I mean, that's something that I'm seeing, and unfortunately we can't break this barrier, deep psychological barrier, that people and marketing teams are structured to focus on channels, not focus on the customer. I mean, that's part of my problem.
So you hit on a couple of. I'm still echoing. Is that me? It says use default mics and speakers. I don't know. So you've hit on a couple of very common things. One is, so we get this question all the time at HubSpot. Why don't we focus on enterprise sales, right? Like selling to the Fortune 1000 sorts of companies, because those people pay more, right? You would assume that they're more valuable customers. But when you look at the ratio and balance, it costs so much to acquire those customers. I got to send like 5 people out there to buy 15 people 50 steak dinners. in order to close one of those deals. So the cost of customer acquisition is very high, and then the long-term value is not that high. Because they're not going to stick around. They may not be that valuable, even if they're paying more money on a monthly basis, which is why we sort of stick in the mid-market. That's why we made that strategic decision, is because the balance of putting $1 into the model and getting $1 out is much, much higher. And then you were talking about sort of this, this psychological propensity towards just, always trying to close and always be closing. We actually see that in sales too, right? Like most sales organizations don't have salespeople who are worried about whether or not their customers stick around. Most SaaS companies, what you'll find is there's actually a clawback. So if salespeople sell a customer that doesn't stick around for a certain period of time, that sales rep will have the commission taken away from them because they're not building, that sort of healthy model. Yeah, so you're definitely right. Like most of this is just a psychological shift in the e-commerce space, because when we started in e-commerce, I mean, you remember like 10 years ago, it was kind of easy, right? Like, spamming Google was easier, and like spamming your email list was easier, and it was a lot easier to do it. Now everybody and their cousin has an e-commerce store, and competing for people who are ready to buy is freaking brutal. And so we have to be able to do better marketing, which means that we have to focus on that customer retention piece, on the activation and retention piece of the model. Yeah, you're absolutely right.
So another important issue that I want to address, Sam, with you towards these similarities between software as a service and e-commerce is actually the support. So on e-commerce, you have let's say, I don't know, 20,000, 50,000, 100,000 customers, and it's not that personal. In software as a service, the support it can be much more personal if you don't have like thousands of customers. But my question is regarding the support. So how important do you think the support and the human connection and the emotional relation that you have with your customer is in retention? Or are we going to an era where we are just fulfilling our needs and we disregard the fact that we are getting the human attention? Or do you think this will persist in the future? I mean, let's presume the human beings are going to be they're deciding for themselves, and not the AI are going to fulfill all our needs, and we are going to be like in Wall-E. So don't go on that route, right? So let's stay on this route where we are still being able to decide for ourselves. How important do you think the human connection and the support is in the retention?
Yeah. So the human bit it's all about the human bit, right? So what we're trying to do with e-commerce is take the relationship that we have with like our favorite corner store sales rep and scale that. Right, so I like to tell the story of Larry, who's my barber, and that's funny because I'm bald.
Okay.
I lost you for a second. He's got this classic Boston townie accent, right? So I get in there and he looks at me and he's like, "You gotta let it go, kiddo. You're bald. You gotta let it go. You gotta shave. Why don't you just let me shave your head? You're bald." I'm like, "Larry, I'm not bald. I still have some hair." And he's like, "No, bald would look good. What you have doesn't even look good." And so I trusted Larry because I'd known him for a long time. I had this very human connection. He was really good at giving me advice. He knew a lot about hair, and I had this like trust because I had this human relationship. And now I'm a bald guy. I shaved my head. Taking that experience with Larry, but Larry probably only has like 30 regulars per month and then 100 other customers per month or something like that. How do you take that trust that Larry and I had and scale that 100,000 times or 1,000,000 times a month? And that's where that Jeff Bezos quote, "We make money when we help customers purchase decisions," really come. Tell me to do something that I didn't want to do and I didn't think was a good idea, but I was willing to do it anyways because I trusted him. Now, marketers fall in love with scalability so quickly that we lose sight of, can we make that human interaction work? right? We try too much to do something 100,000 times that we're not actually good at doing it 100 times or 1,000 times. So that human connection, all of this stuff, this personalization, email personalization, website personalization, content, all of that, what we're trying to do is replicate that Larry-like relationship, and we have to stay focused on that. Because if you have that trust, yeah, people are going to stay around. They'll buy stuff just because you tell them to, right? Like they'll buy stuff just because they trust that what you're saying is the right thing. In the B2B space, you end up with this a lot. You'll end up talking to leads, to potential customers, who the key to them buying from you is that they want to trust that they're being told what to do by someone smarter than them, right? And that human interaction, that's easy to do on the phone when I'm talking to a lead about my SaaS product. It's a lot harder to do in the e-commerce space. Some of them can do that, like Gemvara. If you're really good at keeping customers around, you can spend more money on that, on those real human interactions. But even like messenger bots, like these chat bots, I hate those. The reason I hate those is because all we've done is taken, a new channel and turned it into a choose your own adventure story, right? Like there's not a real human behind it. I was at a co-working space in Montana, and instead of having a chat bot, because the guy gets like 1,000 messages a month, it's not that much, right? Instead of using like some sort of cool automated chat bot, he just answered himself. And it was great because I could ask him all these questions and have this real personal relationship, and I trusted him. So my advice to everybody, and you see this a lot in startups, right? We talk about do things that don't scale is something you hear a lot. Or we talk about things like the Wizard of Oz, right? Before you put the technology behind it, make sure a human behind it can actually do it. Because if a human can't do it, there's no point in scaling it. Really do focus on that, because without that human element, your marketing is commoditized. And if your marketing is commoditized, then your product, your customer acquisition is commoditized.
Yeah, that's a great outcome. I also want to share something with you regarding our own experience here in Omniconvert. So we've been focusing a lot on acquisition because we are a startup. Nobody knows about us. We've been doing 3 years ago. Nobody knew about us. So we were actually followers of Maximizer and Optimizely and whatever. And we've been focusing so much on the acquisition itself, like spread the word, that we actually forgot that the fact that the value that your audience is perceiving about you is the most important asset that you have. So if you deliver value, it doesn't matter that you are reaching 2 million users or 20,000 users or 2,000 visitors, because at the end is that value. And we've been derooted, we were struggling to grow for the sake of growth and for the sake of our dreams and our KPIs and our vanity metrics, that we've actually forgot to deliver value. And you're actually part of our intention, that we deliver real and authentic value to our audience and our customers and our users. Because at the end, if we don't teach them how to become better at what they do and fulfill the needs of their customers, then we are not fulfilling our promise to them. We are just delivering a piece of software that they should click and they don't know what to do with it. So maybe that's the problem in the software as a service world. So I wanted to just get it out from my system, because that's a theme that I've been doing for like 1.5 years.
So when you're first starting off as a startup, the only thing that matters is selling to more people, because it gives you more data, more information, and you just need cash flow. But I made this mistake at inbound.org when I was running inbound.org too, which is that you get so obsessed with that round number. There's actually something called round number bias, which is this psychological propensity to over-focus on like hitting, I wanted Dharmesh to be able to stand up at the conference and say, we have 100,000 members at inbound.org. But probably at about like 60,000 members, we had reached the point where we were losing the same number of users every week as we were able to acquire in our team. So even though we did eventually hit that 100,000 number, and then I looked at the fact that like the activity on the site hadn't actually grown. The traffic on the site hadn't actually grown. None of the core metrics, the weekly active users, had grown. And that's because it's so easy. I mean, you called them vanity metrics, but it's so easy to fall into that trap of, looking at the top numbers that are really easy to influence and not looking at the bottom numbers. Because, I'll tell you a story. I was in Tel Aviv. I was with a startup, and they were doing some churn analysis. And I was sitting in the meeting with their executive team, because I was just an advisor for them. And their customer retention team is doing all these charts and stuff on cohort retention and cancellation and everything. And it turned out that they were analyzing, because I asked for the raw data, it turns out that they were analyzing 4 canceled customers, right? Like, all those charts just represented 4 customers, which is meaningless, right? From a standpoint of statistical significance.
Yeah.
Right. But, while that shouldn't be your main focus until you can get to a statistically significant point, people overshoot that all the time. I do it. You guys may have done it too. Like, we're so focused on growth, on hitting that round number, especially if you have investors. Like, they love those round numbers, 100,000, million, whatever, that we miss that inflection point, because there's no set. I can't give you any guidance. I can't say, well, once you reach 1,000 customers, now you should focus on retention. You have to look at that and see when those 2 numbers are approaching: the number of customers you're losing per month, and then the number of net new customers you're acquiring per month. As those approach each other, then you have to pivot. You have to focus on that retention, or you're really just wasting money. So, I see so many startups go out of business because they're really good at acquiring customers. Like, you hire a hotshot SEO person, and you're great at PPC, and I don't know, you do conferences and all this stuff, but your business model is out of balance because you're not good at keeping them around. So yeah, I mean, you're right. It's not just e-commerce that has this problem. It's almost every startup that I see, because you want to stand up with a big banner behind you that says, our millionth customer or whatever. But you don't get there. You don't get there unless you focus on that retention piece.
Yeah. So mainly to sum up, do you think that shifting your attention from the acquisition to the retention happens when you have enough data to have statistical significance, and also when you see the number of net new, I don't know, MRR or revenue is being, let's say, less than what you're actually losing from the existing customers? But I've tried to do to craft like a calculator to allow the e-commerce owners to understand the impact of the retention, and it was almost impossible. So because the returning revenue, the revenue from the returning customers is fluctuating a lot, and if you don't have enough data, then you don't have a model anymore. So mainly you need to feed the machine, this calculator, with enough data. Have you made something in that direction, or have you seen any modeling model that works around this topic?
It's going to be specific to each company. So this is a question that almost everybody asks, and I've also played around and trying to build a free tool for this. But the variables in customer lifetime value, yes, one of it is average order value, which is the only thing most e-commerce companies care about. But then also is the repurchase pattern. What that repurchase pattern is going to be incredibly variable. So there's a concept in startups and in innovation called the jobs to be done framework. And Henry Ford has the most famous quote on this, which is that if he'd asked his customers what they wanted, they would have said a faster horse.
Yeah.
Right. Obviously, he didn't found the Ford horse breeding company. He founded the Ford Motor Company. By understanding that bit and then making sure that value loop is delivered over and over again, even if they don't purchase, right? Like checking in and saying, like, did you successfully build the deck, right? Or, if you're selling, deck making supplies, making the post-sale support be about what was it the customer was actually trying to do, not whether or not they're ready to buy again, making sure that they were successful with the product. That then gives you the right and the context and the ability to continue selling to them over and over and over again. The weirdest thing for me being at HubSpot, so we forcibly unsubscribe people sometimes because if they haven't clicked or opened or something in a long time, we'll just auto unsubscribe you in order to preserve our deliverability. And people will like email us like angry. Be like, hey, like, I was gonna get around to that. Like, I was gonna read that, and the emails we have aren't about the HubSpot software. It's just about helping you be a better marketer. Because if you're not a better marketer, whether or not we have good marketing software is irrelevant, right?
Yeah.
So when we always, God, e-commerce is the most guilty of this, and I can say that because I was in e-commerce and I remember doing this. I worked for cheaphumidors.com. We sold humidors cheaply, and the only thing we cared about was that top line growth because we wanted to do things that scaled like a million times because that was originally why we loved e-commerce, right? Like when I was at Cheap Humidors, we were making $5 million a year. There were like 6 of us in the company. Like it was great, right? And we don't want to do the things like actually hop on the phone with customers. So yes, so you've got those 2 numbers. You've got whether or not customer attrition or churn and customer acquisition are approaching the same number. But then, yeah, you absolutely have to make sure that those numbers are statistically significant. Any team, I don't care how good you are, almost any team can focus on just one thing at a time, right? You can either focus on top line growth, midline growth, or whatever until you like IPO and become Oracle or Amazon or something. You can have 100 people working on each problem. Last time I was in Romania, I heard a great Hebrew phrase that was he who chases 2 rabbits catches none, right? So you have to make a very important decision as to which of those rabbits you're going to chase. The statistical significant piece is weird. Like some of that just, and this sounds weird coming from a data guy, some of that's going to be your gut feeling, like you know the customers better. You should be talking to them, actually physically calling those customers and making sure that they're being successful in order to pivot focus. And it's finding that cohort retention that you talked about, or I talked about earlier, enterprise companies versus mid-market companies, finding which ones have that product market fit and then focusing on those, right? Focusing on the retention and acquisition for that bit. So that's a hard question to answer. I don't know. There's no universal answer for everybody. But no, you should not make decisions based on very small sample sizes. That being said, most people wait until there's way too long, right? Like you don't need, a plus or minus 3% margin of error with 99% confidence in order to know that people aren't sticking around and continuing to buy from you.
Yeah, you've actually answered my question. But I have another one, and we are approaching the end of this session. So I wanted to ask you something which is mainly about the whole marketing world. So we have, I'm calling this information noise. So we have so much data around us, and we've been chatting with our customers about their problems because we were seeing about their win rate and how many experiments they run and stuff like that. And we've understood that they are overwhelmed with demands from their management team, and they are now, the business is asking them, okay, grow this metric, grow that metric, and but I have a processor here in my brain, and I have a capacity to get data in, and actually I can't do it anymore. So they are somehow overwhelmed with data and with know-how and with tools and with the dynamics. This dynamic world is going at a crazy pace, and they don't know where to look anymore. So mainly they end up staying like 8 hours, 9 hours, and then go home and forget about all these crazy metrics because the demands are too high. Have you seen that? And do you have I don't know, how do you cope with so much information at this moment?
So the weirdest thing to me is you think about what marketing was, 15, even 20 years ago. It was like a joke inside the company, right? Like it was the first thing, if there were any problems that, you cut the marketing budget. It was like the joke. And the marketing team just like sat in the corner playing with crayons, like maybe designing some brochures for the sales team and like setting up the booth at a trade show. And you would, if you were lucky, you would, buy these TV commercials and then call it branding. But like nobody knew what that meant, right? Like nobody really tracked that. That was just an excuse for us to not measure our jobs. And we've gone from that to like now, and I'm as guilty of this as anybody. Now we have to own the whole growth funnel, right? Like we have to be responsible for acquisition, for retention, for activation, for monetization, for all of the pieces of this funnel. But the company org structure has not caught up to us yet. right? So, most companies will have like a 1 to 100 or 1 to 200 ratio of the people on the marketing team towards the rest of the company. SaaS companies, you're going to find the ratio is more like 1 to 5, right? Or 1 to 10 maybe. I think at HubSpot, what do we got? 200. So yeah, right at about 1 to 10 for the entire company, engineers, support personnel, legal, everything with the marketing team. And that's because you have to grow. If you're going to expect that team to own everything, now it's like suddenly responsible for the entire growth of the whole business. You have to change the way that you make investments. You can actually have a smaller, for example, in SaaS, smaller sales team if the marketing team's really good, right? Because the sales team is getting these at bats that are just easier to close. They know the process. The marketing team's doing all of this stuff. You used to have a really big sales team because the sales team was responsible for developing its own opportunities. Now that's shifted, right? We actually have almost a 1-to-1 ratio at HubSpot, I think, of marketers to sales reps, because the marketing team is responsible for so much of that process. And we're also responsible for customer success, right? Like we have a smaller customer success team because of that. So Shopify actually just rolled all of these into one growth team, right? So like they combined their marketing team and their product team and just like created a growth team. That's one approach. It has its own cultural drawbacks and its own difficulties to manage, just because engineers are a pain in the butt to manage for marketers. But you've got to make that change. And then I will say, one of my favorite quotes of all time, in addition to I love that he who chases two rabbits catches none. One of my favorite quotes of all time was from Ariana Huffington. She spoke at the Inbound event, and she mentioned that you can cross things off your to-do list by deleting them. And I think there's this pressure on ourselves and there's pressure inside the company to be good at everything. We use a strategic framework at HubSpot called MSPOT. So the M stands for mission, the S stands for strategy, P stands for playbook, O stands for omissions, and then T stands for targets. The omissions piece to me is the most interesting piece because we literally list out things that we probably should care about, that probably do matter, that we're going to ignore entirely, right? So every quarter when we redo our MSPOTs, we list out things like, we know that this matters and we are not going to focus on it. Really smart people, by the way, like if you're managing smart people, it's a giant pain in the butt because it's so uncomfortable for them to see something that they think is important going unsolved. But you're not going to be able to do anything effectively if you're trying to do everything. It's the same approach to like, how you design your marketing, right? If you're trying to have your marketing or your product inventory be somewhat interesting to everybody, right? Like you talk about your A/B testing, your landing page, like you just want to see what's the most sort of interesting to everybody instead of, the best to individual people or individual cohorts. If you can't solve that focus problem, then you're not going to do anything well. I still have like nightmares of my old boss, Dharmesh, like standing on my shoulder, whispering in my ear, like a tiny version of him, like focus, focus, focus. And that's really been the one of our very real keys in SaaS is, yeah, that matters. Conversion rate matters, all this stuff matters, but don't do it half-heartedly. Like ignore it entirely and do one thing at a time and do it very well.
Yeah, that's great. I just want to add on this another metaphor that I'm using when I'm talking with our team. We have these two times per month gatherings when we are focusing on an aspect about our culture, and when we set priorities, the fact is that there are so many opportunities that we are overwhelmed with opportunities. There are everywhere opportunities or things to fix. But when you make an omelet, you have the same. If you have all the elements, right? So you have the eggs, you have oil, you have salt, but you have a cooking oven, and you also have to have the fire and gas, right? But if you use the same things but not at the exact order, then you get nothing. So if you add there the eggs and then the cooking plate or whatever, you're not going to get an omelet anymore. So, or if you put salt and then you wait and turn the fire on. So it's the same thing. You have the same elements, but the order is that what matters. So I think you've nailed that
I
very,
love that.
very good. Yeah.
I love that. Yes, like the peppers matter, right? The oil matters, the salt matters. All of those are very important things. It just doesn't matter right now, and you have to make like a choice that you explain to the team, right? Because marketers are very also tend to be both intelligent but also emotional people. Like explain to them, like, listen, I know this matters. Like, yes, we're going to add salt to the omelet, but we're not going to do it right now because this isn't when we need it. Yeah, I love that. That's a good metaphor.
Yeah. Okay, so I think we are getting to the last question, Sam, which is mostly regarding the future and the ethics and marketing. So I've been looking at some interesting video yesterday about wealth versus health, and the fact that we as marketers are actually apart from the companies which are having this mission that they are packaging here and there. But the truth is that we are getting to a mentality that the resources are infinite and growth can be forever, which is not true. So we don't have like 5 planets to play with. We have resources which are limited, and we need to take into account not the growth but the health of our planet and of us as a race, right? So mainly, what can we do to turn this over, and how can we shift our mentality? Because we are being used, our minds and our brains and our everything, we are being used towards a growth which is not getting anywhere. Because at the end, look at I have this problem with Google. I've wrote I don't know, 2,000 articles that I posted today about the fact that Google is actually getting everywhere, and they have this approach like don't do evil. But the fact is that they are getting everywhere. They are getting into this testing world. They are getting into the personalization. They are getting everywhere. So they are just a machine that feeds with growth and with revenue. So don't do evil and all those stuff. Forget about them. So where can we position ourselves, and what can we do as marketers once we become aware of this problem that we as the whole planet have?
Wow, you really saved like the easy question for the end. I mean, part of what you're talking about is like the fundamental nature of capitalism, right? Like there's this weird thing, particularly in the United States. We're trained to think of capital as this like scarce resource. We have more free capital, just cash, sitting on balance sheets at businesses than at any time in human history. We got more than $2 trillion worth of cash. It's just doing nothing because we can't figure out something interesting to do with it. And so like the model of capitalism has been so successful that it's actually sort of hurting itself, right? Like we just don't have those sorts of interesting things to do, which is why now you can either go wide, right? Like start exploring new markets, or you can invest in self-disruption, which is what the really smart companies are doing, right? Help companies invest in smaller companies that are going to disrupt you. There's that bit. There's also the bit, right, of like, yeah, infinite growth is also like an underlying principle of business economics, is that like you should always be taking that cash and growing, and we're reaching that inflection point. There's a great book I read called Homo Deus recently, which talked about like how much more free time human beings had when we were hunters and gatherers, right? Yeah. Versus what we have now that we work at an office. We talk about it like it's so great, right? Because I got my little latte here and everything else. I got my cell phone, but we actually have far less leisure time. Man, you really saved a tough question. We're eventually going to have like an elastic reaction where we've reached the upper limit on growth. There's not more that we can monetize, especially not without just really driving like massive inequality. Income inequality, this worries me a lot, right? So I think about companies like Amazon. Like I said, they make $200,000 or $300,000 a minute last time I checked, and almost no profit. And the reason they do that is because they're growing the value of the company, right? And as a CEO, you're accountable to shareholder returns. You can do that one of two ways. You can issue dividends, or you can grow the value of the stock. Dividends are kind of a crappy way to deliver returns, because what that means is that I have nothing more interesting that I could do with your money than just give it back to you. But But in the world that we live in, usually the company can do something more interesting with that money. And so we focus on growth and growth and growth. You know, Salesforce just had their earnings call. We had our earnings call. And profitability in Amazon, profitability isn't the focus. It's eventually got to change, right? Like you've eventually got to, you know, there's an upper limit on that growth. But the problem is we're talking, you know, Amazon's going on 20 years of doing it this way, you know, totally fine. So I don't know. Yeah, I mean, that question opens up like 16 other questions. We've got to talk about like universal basic income, and then we've got to talk about like everything else. So, but yeah, that is a concern that I have. And one thing that I will say before we end this, I was talking to a VC guy in Seattle, and he talked about how he has to explain to founders that it's okay to only build $100 million company. Right? Like everybody wants to build like the $1 billion company and do all this interesting stuff. And that's fine. And I'm not saying that you shouldn't try to do that, but it's okay to like own a buyer persona, right? It's okay to like own that part of the universe, and be really, really good at it. And, you know, maybe you're acquired by Google down the road if they see something super interesting in your model, or maybe you can just continue, you know, having that monetization. So yeah, growth is not forever. There's an upper limit on how many people we can have. We're not there yet. Like we've got like another couple of decades probably until sort of the global market has stabilized to the point where we've just exhausted options for growth. Maybe by then Musk will have opened up the routes to Mars and we can just go there. But yeah, I don't know. I wouldn't worry about that too much because most of us do still have that growth problem. Like we're not growing enough because we're not focusing on retention enough. But that is something that these bigger companies do have to think about, because what the hell else are you going to do with this cash, right? Everybody wants 15% plus returns on their cash every year, and so you've got to do something interesting with it. You can't just leave it sitting there like we are now.
Yeah, I think it all has to do with the end goal. You know, our end goal. We are being used by this system. You know, we are being used by this system to provide economic growth, and the end goal is to provide revenue, whatever, you know, valuation, a higher valuation for our companies. But I think the system is so much changed right now that the states are not actually directing the show anymore. I mean, the governments are not directing the shows. The economic players are directing the show, and the whole world is actually being directed by, I don't know, Facebook, Amazon, Google, Apple. You know, these are the players at the stake at this moment. So I think what is important is that they become aware about their mission to direct the humanity to the next level, not to direct themselves to the next level of growth. And unless they become conscious and aware about their mission to change the destiny of the humanity itself, we are going to chase for illusions, which are numbers. But at some point, the humans are exactly like companies. So at some point, we are not going to be happier anymore by earning more money. So, you know, it was that thing that after $200,000 per year, you're not happier with any cent that you put after that. You are happier if you have, I don't know, relations and whatever. I think the companies should become aware about this mission and to make the society happier and healthier.
Yeah, we're just not set up for that, right? Like CEOs have like a legal fiduciary duty to optimize for shareholder value over everything else. And like if you don't do that, you expose yourself to actual legal risk. I mean, I agree. Like I look at Elon Musk and some of these folks are, you know, you look at Mark Zuckerberg. Mark Zuckerberg is the head of state for like the third largest country in the world.
Yeah.
Or like, and you look at Elon Musk and he's focused on all these sort of big, or Richard Branson, you know, focused on all these big sort of society-oriented questions. Yeah, I don't know. It's weird. It's really up to them. I mean, we can't make them change their minds and focus on that. Yeah, I don't know. That's interesting. Like the system's just not set up that way, right? So what you're talking about is like a fundamental change to the global economic and political system. So maybe we can get together and write a book on it, but we're not going to hit it in a webinar.
That's for sure. Yes. Anyway, Sam, it's been fun. It's been great. I've got a lot of ideas. Actually, I'm gonna apply them in my own business, and we're gonna address our audience with the know-how that you've shared with us. Thanks a million for your presence here. And hopefully we're gonna have you another webinar in the future. So may you enjoy the rest of your day, and you, our audience, thanks a lot for watching, and may you succeed on your goals if these are aligned with your mission and with your health, right?
My pleasure, guys. Thanks for having me. Happy to come back anytime. You know I love you guys.
Thanks. Excellent. Thanks a lot, Sam. Goodbye.
Bye.